Good evening. I'm Jules Constantino, the President of the Institute and Faculty of Actuaries. It's my pleasure to welcome you to the 2018 Autumn Lecture here in Edinburgh. It's particularly pleasing. So firstly, we have around about 300 people in the rooms here, the assembly rooms in Edinburgh, which is fantastic. We have another event going on at Staple Inn Hall, our home in London. So there's a group of people there who are watching the live feed. And there's another group in Johannesburg. Actually, Marjorie Ngwenya, the immediate past president, is actually leading that group, and they're listening in. And we have 250 people who are watching the live stream. I'm delighted to introduce our speaker for this evening, Lord Myners. In his lecture, he will share his thoughts on how we define long-term when it comes to investment. Now, long-termism, I guess, is a subject close to actuaries' hearts, and Lord Myners is particularly well placed to speak on this subject. He is currently chair of the UK operations of CVN Capital, LLP, where he is responsible for identifying potential investment targets, working with boards and building alliances with other investors. From 2008 to 2010, Lord Myners served as Financial Services Secretary of Her Majesty's Treasury. Prior to this, he had an active career in the City of London with N.M. Rothschild. Before entering government, he also served on the boards of a broad variety of organizations, including as chairman and director of Guardian Media Group, chair of the Low Pay Commission, and chairman at Marks & Spencer's Group. He has also served as a non-executive director of the Bank of New York since 2002 and the Bank of England from 2005 to 2008. Some actuaries in the room may recall the 2001 Myners Report, a review of institutional investment for Her Majesty's Treasury, the recommendations of which made a valuable contribution to collective investment, and in particular, pensions investment. So without further ado, please join me in welcoming Lord Myners.
Good evening. Thank you very much, Mr. Chairman, members of the Institute and faculty, and your guests, both here in the assembly rooms in Edinburgh and in London and Johannesburg and other places where we're linked to this evening's event by the internet. Welcome. In June 1988, I was invited to take tea at the Bank of England by Jonathan Charkham. Jonathan was a former industrialist, barrister, chairman of the Athenaeum Club, father of the yet-to-be-famous divorce lawyer Fiona Shackleton, and, most relevant to this discussion, an advisor to the Governor of the Bank of England on business. Jonathan was a wise but thoughtful member of the establishment. The Governor at the time of the Bank of England was Robin Lee Pemberton, a Kent landowner. His estate included the only private Eton Fives court in the country. You're beginning to get the picture. He had no financial qualifications or executive experience in banking or finance, but he was probably one of the 2 or 3 best governors that we've had since the end of the Second World War, probably only short by a small margin behind Eddie George. Tea was served from a silver pot in the finest Staffordshire china. Jonathan wanted to talk about his growing concerns about the short-term focus of public equity investment. I'd already begun to speak on this subject myself. Jonathan's interest in this area led him to push for the writing of the Cadbury Code on corporate governance, and he actively promoted ProNed, an organisation within the Bank of England designed to improve the quality and quantity of non-executive director candidates. Jonathan and I had both rejected one definition of short-termism, which can be measured by how long an investor holds an individual share. Because you hold a share for 10 years and somebody else holds it for 10 weeks, does not necessarily mean that the former is long-term and the latter is short-term. Somewhat misleadingly, the Investment Management Association and the London Business School nevertheless produced a report which sought to measure the average length of holdings and concluded from this that investors were not short-term. Since then, of course, the velocity of trading of individual shares has risen astronomically. Jonathan and I were agreed that the heart of defining long-term in equity investment was an issue of attitude and behavior. We saw an increasing focus on securing an early effect from investment at the expense of looking to the distant future. Investment showed little appetite for deferment of gratification. Investment was certainly not far-sighted and enduring when it came to the mainstream of UK equity investment management. I'd become chief executive of Gartmore Investment Management in 1985. Gartmore was a small independent house with a joint heritage in Glasgow and London. We managed just over £1 billion. Each day on my desk when I arrived was a computer printout indicating the percentage holdings we held for our clients in each individual company in which we had invested their funds for them. Initially, this report showed pretty small percentages, 0.1%, 0.3%. This was entirely consistent with the fact we were a very small investor by comparison with the bigger names in the UK. But we were fortunate to grow our funds under management over the next 15 or 20 years until we'd reached, by the turn of the millennium, a figure of nearly £80 billion under management compared with the £1 billion in 1985. And as this happened, I saw these percentages increase. So I looked at the report each morning, I ran my finger down, and I saw the occasional 5%, 10%, occasionally even more than 10%. So at one of our weekly investment meetings, I asked my investment colleagues whether they believed that there was a point at which our percentage ownership of a company might mean that we've moved into a position of having new responsibilities. Responsibilities to the firm as a leading owner. I posited that the responsibilities that you have at 0.1% were generic, to support good governance, to put your hand up in committed and enthusiastic support for codes. But it didn't seem to go much further than that. But that may not necessarily be the case if you own 10% of the company and you happen to be the largest shareholder. My colleagues rejected my view. They argued that because we owned 10% at a particular point in time did not necessarily imply a different view, a longer-term threshold, an elevated commitment, more responsibilities. Our clients, they argued, had placed their money with us to achieve better returns than they would get from other managers, or at least in the expectation that they would. Accordingly, we manage fairly diversified portfolios. Frequently in UK equities, we'd have shares in over 100 individual companies, because this ensured that our performance broadly tracked the benchmark of other managers with similar mandates or the main indices. We didn't see ourselves as owners. Gartmore and other investment managers at that time and now place a premium on portfolio liquidity, the ability to sell an investment fairly quickly. and we certainly did not want to become insiders in possession of material, non-public information. And we had no real competency to act as an owner, whatever that might mean. We had not developed a skill set because it wasn't necessary for the way in which we manage portfolios. We limited our engagements with companies to 2 or 3 meetings a year, and we largely focused on the very short term. Nor did we believe our clients expected us to do anything different, because they never raised the subject of responsible ownership. Albert Otto Hirschman, the German political economist, spoke about organizations similar to ourselves as having one of 2 primary responses to a deterioration in the service received from an organization, a political party, a company. He said you had 2 powers. One was exit, which he described as an economic act, and that is simply to not vote for that party, to not shop at that particular business, to not stick with that particular fund manager. Or the second option, voice, which he said was a political act, attempting to improve the relationship and outcomes, sticking with it. Institutional investors in quoted UK equities have shown a consistent preference, decade after decade, for exit and not for voice. This, I believe, is a direct consequence of setting relative performance goals. You're not, on the whole, set targets to produce absolute returns. You are set performance targets which are defined in terms of an index or a balance of other managers or some other relative concern. And we all know, or should know, that probably one of the most important investment decisions you make as an asset owner or a pension trustee is the choice of benchmark. Because in the absence of strong views, the manager will follow the benchmark. And that is exactly what happened. And portfolios began to look increasingly similar to the portfolios managed by other managers and similar to indices. The necessarily high portfolio diversification to ensure the capture of broad market returns, what some people call beta, was one based on portfolio diversification. But how did you do better? Because through this diversification and replication, you would match the index, but your clients were asking you to do more. Well, you ducked and dived around. You took a little bit more in one company than the index and a little bit less than the index in another company or sector. And if you were fortunate enough to get it right and you'd locked in a few basis points of performance, you went back onto the center line of the index again. So this was an approach of diversification and relatively high portfolio turnover, not an environment in which institutional investors could ever become comfortable with the concept of being corporate owners. How can I be a corporate owner when I have shares in more than 100 companies and when I have little contact with the companies and where my present holding may increase or decrease in the quite immediate future because of a change of market mood or something which I'd spotted and thought I could trade to advantage? Any idea of such fund managers being engaged owners, investing for the long term, was clearly a nonsense. It simply did not reflect the predominant style of investment management in equities. That was the case 30 or 40 years ago. It still remains the case. Fund managers neither have the economic incentive or skill to become surrogate owners. They value the freedom to trade over the ability to engage. Many of our large companies have become what I have described as ownerless corporations. The leadership of the company sits in a vacuum with little contact with the owners of the business or the intervening owners, the fund manager, which can anyway be described as focusing on the long-term prosperity and future of the company. These ownerships may be transient. They're not deep, they're not meaningful, and conversations are focused on the short term rather than the medium term. Fund managers have tried to address some of the public anxiety about this by the appointment of governance experts. I've met lots of them. They're good people. They are diligent. They take their job seriously. But the truth is, they're under-resourced and frequently underheard within their own firms. So there are now more people in the investment industry, I suspect at least 3 people in the hall this evening, who've got on their job description corporate governance. But whether they have real influence on their portfolio construction colleagues is pretty questionable. Whether they're invited into critical investment decision meetings is not, in my experience, the case. And they don't generally have any of the sort of experience of high-level corporate leadership that you might expect someone to have if they were positioning themselves as the institutional investment management house voice on culture, purpose, strategy, capital allocation. It's quite extraordinary that in a very well-paid profession, I'm not sure that investment management does meet all the tests of being a profession, but despite being very well remunerated and probably quite interesting work to do, there are hardly any fund managers, as far as I'm aware, who have had any material experience in business. They've gone straight from university or business school or one of the professions into portfolio management. Seems odd to me that we don't at least have some people who have some business experience. I remember saying to my mother, we were talking about, when I was at Gartmore, about investment in retail, and I said, "Oh, well, our retail expert says this," and she said, "Oh, well, how long did she work in retail before she worked for you?" And I said, "Well, she didn't at all." And she said, "Well, tell me more about her." And I said, "Well, she's age 24 and she's a recent graduate from Exeter University." Exeter is a brilliant university. I'm Chancellor. But that hardly qualifies you to be the expert. I'm going to suggest to you, ladies and gentlemen, that that continues to be the norm. The conventional view at the time, when I met Jonathan, was if companies got into a mess, the right approach was takeovers. Let BTR, let Hanson Trust and others take over these companies and improve them. Well, what we've learned subsequently is they rarely improved the companies and they were normally playing accounting tricks. But that continues to be the case. The UK has the most permissive culture and rules in the world for the takeover of public companies. There is no market in the world where you can more easily and more quickly take over a public company. Why is that the case? There's been no public debate about the benefit to society and the economy of being so permissive. We look to the takeover panel, and they say, we've got good rules. Well, the takeover panel, I'm being slightly provocative here, is largely staffed by investment bankers and corporate lawyers who are in the business of earning fees from company takeovers. Nobody is seriously challenging why it is so easy to take over a UK company. And how easy is it? I would stick my neck out and say just about every major company in the UK, in the FTSE 200, could be taken over quite quickly with an offer at a 30% premium to the current or recent high share price. Owners have no commitment to companies. They're rather like owners of racehorses, or people, more importantly, who put money on racehorses at race meetings. They care passionately about what this horse is going to do in the 3 minutes after the start of the 2:30 at Sandown Park. The race is over, they collect their winnings, or they don't. Do they bother at all what happens to the horse afterwards? Do they bother that 0.5% of all horses going home from race meetings die in the journey home? No, not really. Perhaps they don't know it. Perhaps they would be upset a little bit, but it's not the way it works. And it's simply not the way it works if you have a share in a company and you've sold it or there's a takeover bid, you buy something else. Does it matter? Well, it matters that we don't have a single significant pure technology company in the top 100 in our index. The UK, which has such wonderful universities, has not promoted a single technology company that has obtained a public listing and continues to be listed. They've all been taken over. So this focus on the short term, focus on immediate gratification, this desire to be hit by the drug of an immediate impact is broad-reaching in portfolio management today as it ever was. Of course, this evening I want to limit my talk to public equity management, but I do want to make some references to academic work. But before I do so, I should say, first of all, some of the academic conclusions are quite debatable because defining long-term and short-term and trying to move from correlation to causation is quite difficult in a soft area like attitudes. But I would add that some of the academic work I'm going to mention does pretty much align with my experience of over 40 years in fund management and in business. It's my central contention that business leaders are prone to place too much emphasis on the short term and not enough on the long term. So here I'm talking about the business leaders rather than fund managers. But I believe the business leaders do this because they are under pressure from the fund managers who are set short-term performance goals by the asset owners. So you've got a structure here in the asset chain. You've got the asset owner, say the trustee of the pension plan, or the directors of the insurance company, you've got the asset managers, and you've got the companies. And pulling them all together is a powerful short-term focus. A report published by the respected Aspen Institute in 2009 concluded, quotation, fund managers with a primary focus on short-term trading gains have little reason to care about long-term corporate performance or externalities. The racehorse. The simile I also use to describe this is the attitude of someone who is driving a rental car compared with driving their own car. If you drive a rental car, I'm confessing this, I don't think I'm the only one, you probably get a bit closer to the curb, you probably go over those speed bumps a little faster. You probably, if you're driving a rental car, don't check the oil, you don't check the water, and you absolutely don't empty the ashtrays at night. And I think the difference between a long-term investor and a short-term investor is captured by the mindset of the difference that I would draw there between your own car and a rental car. The short-term focus I have been describing reduces aggregate investment returns and detracts from economic prosperity and social welfare. There is a direct economic and investment consequence of a short-term focus. No one runs a marathon on the basis that you will win every individual half-mile stage in the race. But that's actually, in some ways, how our major companies and our largest investment institutions confront the challenge of business leadership and portfolio management. As a result of which, relationships between fund managers and companies and between fund managers and the asset owners, the trustees, can often be quite fractious because they're based upon a wholly undeliverable belief that you can win every half mile and that the long term is a succession of successful short terms, rather than, as Keynes told us, that one of the keys to success in investment was to tolerate periods of relative underperformance as long as you believed your analysis remained true. Where is the evidence of short-termism in business investment? In 2013, McKinsey and the highly respected Canada Pension Plan Investment Board conducted a survey of more than 1,000 members of public company boards around the world. 63% said the pressure to generate strong short-term results had increased over the previous 5 years. 44% said they had a time horizon of less than 3 years in setting investment strategy. 73% said they should be using a time horizon of more than 3 years. Focusing capital on the long term, an organization designed to address this issue, found that 61% of executive directors, finance directors in particular, would cut discretionary spending to avoid an earnings miss. And 47% would delay supporting a significant new investment with a high net present value if it would have an adverse impact on short-term reporting. There is the evidence of the pressure of short-term thinking. Graham and Harvey, two professors at Duke University in 2006, found that 39% of public companies' CFOs would persuade customers to bring orders forward and play other tricks rather than avoid missing a short-term earnings target. As the US Wall Street lawyer Marty Lipton says, American companies are caught in a quarterly trap. The long term is for the birds. This, I think, is also evidenced by the sell side, the brokers, their research people. Almost no sell side research people produce reports more than 2 years out. They don't produce forecasts more than 2 years out. And I don't think anybody goes out more than 5 years. This is an incredibly short period to forecast the future of a corporation, when the focus should surely be on how's this business going to be performing and delivering value over the next 10 or 20 or 30 years. The frustration experienced by public company directors was evidenced by some research by Achara, Keogh, and Rayner, who found that directors who had sat on the boards of both public companies and private companies found the private companies to be intrinsically more satisfying because there was more focus on the long term and less focus on risk avoidance. The Bank of England in May 2011 also published a report on short-term investment decision-making, evidenced in public company valuations. Discounting cash flows 5 years ahead at rates which were more appropriate for 8 years. Investors were using a 5-year discount rate rather than an 8-year discount rate. At investments where a 10-year rate would have been appropriate to discount an investment, companies were using 16 years. And they were applying scarcely any value to cash flow beyond 20 years. This is pretty powerful evidence, and I said it accords with my own experience. This is not a culture which encourages investment in new ventures with risk. It points business management to focus on infill investments, cost reductions, dividends, and share buyback, rather than investment and innovation. R&D and investment as a percentage of GDP is at record levels. Dividends and buybacks are also at record levels. The former at record low levels, the latter at record high levels. This is not supporting companies' investment and corporations for the future. It's extracting cash. Economists have estimated that the aggregate effect of this short-term bias is to take something from 0.1 to 0.3% per annum from national GDP. Not sure whether that's an accurate figure. It seems to me to be the right side of the line. It's certainly quite a significant figure in the context of the Chancellor telling us that economic growth over the next few years is going to be in the range of 1.5% per annum. In 2004, Mori was commissioned by the Investment Management Association and the NAPF to ask questions of pension fund trustees and company management. A third of NAPF members and two-thirds of IMA members agreed that investment mandates were creating short-termism. But nothing was done about it. The evidence was there that this was something which needed attention. So until we see something done about this, fund managers will continue to hold portfolios which are very diversified. This will include holding what are described as underweight positions. This is when you imagine a company represents 10% of the market or the index, and the fund manager is not optimistic about the future or the management and decides then don't want to be fully exposed because they think it's going to underperform. So they have a half weighting. They only have 5% of their portfolio. But they do have an investment. Now think about this. The manager is putting money into an investment which he believes or she believes will produce an inferior return to the market. Why are they doing that? I think they're doing it largely in response to ill-thought-through objectives, the relative return focus, and also probably agency protection to ensure that the company, the fund management company, doesn't stick its neck out too far and its performance collapses and its business comes under pressure. But goodness me, if you hold an underweight position in a company, what incentive do you have to be a good owner, an engaged shareholder? You have none at all. The worst thing that happened would be that actually you got this wrong and the company that you decided to have a half weighting in did terribly well. So I'm sure you do the right things because you're professional, but I'm not sure you're going to get yourself out of the bed at 6 in the morning to drive corporate performance in a company which you have a half weighting exposure to in your portfolio. Highly diversified portfolios also lead to excessive stock turnover. Let me tell you another fact about fund management, about active mainstream equity managers. I always have to say this because I can then say, but I wasn't talking about you. More than half of active equity portfolio managers would have produced better returns over 3 years or more if they had done nothing during the 3-year period. They had just sat on their opening portfolio and gone off on holiday or read good books or joined a choral society to sing the war requiem. Can you imagine any other profession that would have as a major promotion line, actually, you're probably going to be better off if you don't use us? What does this tell us? It doesn't tell us they're incompetent. It says that it almost certainly tells us they engage in too much trading, which takes the top off performance. I guess I could cite as further example of a short-term focus the fact that we call executive incentive schemes, which pay out after 3 years, long-term investment plans, LTIPs. 3 years, long-term, running a large company. What can you do in 3 years which really affects the long-term value of the company? I think not a lot. And yet, the conventional approach is that LTIPs should be only 3 years in length. So, what can be done? I've rejected some ideas that are being followed in other countries of giving long-term holders higher dividends or more votes, because as I said right at the beginning, I don't think the duration of holding is the issue. It's the mindset that you really try to affect. Government and regulators have done some good things here. Government endorsed the adoption of MiFID. It has implemented many of the policies recommended by Sir Damon Buffini in a 2017 report on long-term investment, or patient capital as it was called. They've reduced the frequency of required financial reporting. That's good. At least we don't now require companies to report on what happened over the last 90 days. We seriously ever believe that 90 days was a significant reporting period for a company? Not in my experience. Very little of any significance happens over 90 days. The government's also been pushing the Financial Reporting Council to add more bite to the stewardship code and to encourage institutions to support the investor forum. There are other things government could do in the way of tax. It could, for instance, and I believe that this would address some of the problems of underweighting and high portfolio turnover, change the tax on pension funds and mutual funds and OICs, so that rather, as in America, the fund pays capital gains tax and you get a capital gains tax credit, rather than you paying capital gains tax, as we do in this country, when you sell your fund investment. Our approach enables high portfolio turnover. The American approach acts as a deterrent on high portfolio turnover, and that's borne out by the data as well. So there's something the Treasury could do. It also has the side advantage that it brings forward the appearance of tax revenues, which most Chancellors of the Exchequer get very excited about. We could also introduce some form of Tobin tax on trading in equities and, importantly, derivatives to suppress the volume of relentless activity. I think the Financial Conduct Authority could look in a couple of areas. It's doing good work on truth in labelling, in identifying fund managers who describe themselves as active and charge active fees, but actually are pretty much running an index fund. I think the FCA also needs to look at liquidity restrictions on funds. I think it's reckless to allow equity funds to be redeemed on 24-hour notice. It actually encourages the portfolio manager, where there's always a threat that you could get a wall of redemptions, to keep that portfolio very diversified and very liquid, focus on larger companies, and certainly not to take significant concentrated positions in smaller companies. I would argue that no equity fund should be redeemable on less than 7 days' notice, and some of the more complex ones should be a lot more. In 2001, I produced a review for the Treasury on institutional investment, as your President has said. The review ran to a couple of hundred pages, but the key message can be captured in a single sentence. There needs to be a step change in the competency and the quality of decision-making by asset owners and others in the investment chain. The competency and effectiveness and quality of decision-making was not good enough. Since then, there's been considerable improvement, particularly by larger schemes. But the fact is, we have not got as far as I expected. I still find too many examples where, although the fund trustees swear to their compliance with what's now called the minors' principles, they don't achieve the standard that I have in mind. I think that's particularly the case with the approach to the investment principles has to setting goals and benchmarks, of offering and using a wider range of investment opportunities, and the trustees evaluating their own performance. I think trustees need to be asking more questions about whether this model is really working. Is this focus on the short term really delivering? Incidentally, trustees are pretty indifferent at switching fund managers. The vast majority of them, when they switch from a poor performing manager to another equity manager who they think will make better returns, would actually, all things in, generally have done better if they stayed with the firm they fired. I think that's a challenge for people to accept. I also argued in Investment Principle 7 that trustees should think about providing more flexibility around investment objectives for at least some managers. I think the time has come for a thorough review of the investment principles, with a challenge to raise standards in general, but in particular to ask questions about this short-term focus, because I think there's a national, social and economic consequence of essentially inefficient use of scarce capital. I would encourage the Department of Business, the Treasury and DWP, together with the pension regulator, to invite a new pair of eyes to look at the investment principles with a particular focus on issues relating to the pressures of the short term. I think there is an opportunity for a new style of management, a hybrid of the best of public equity and the best of private equity. It's not really being employed at the moment in the UK. This would be a portfolio approach which probably had 20 investments, would be an approach where perhaps representatives of the fund manager sat on the board of directors, where the fund manager accepted that being an insider with voice was better than keeping the door open for exit. Very close working relationships and a sense of commitment from the investor that we are there to support you in new investment, in pursuing new opportunities, unlike other fund managers who are not willing to give you any real commitments. I believe this can be done. I believe it should be done. I think a redrafting of the investment principles would provide an opportunity to facilitate a broader range of investment options and, importantly, and I close with these remarks, address the endemic, pervasive, ever-present, short-term emphasis in investment and business management, which is delivering suboptimal returns for asset owners, is incurring unnecessary costs, fees, and transaction costs, and is threatening the fabric which should link public companies to public investors. One of the reasons we've seen the growth in America of unicorns, very large private companies backed by institutions but not going public, or why we have seen a dearth of high-quality IPOs in this country, public listings, is because increasingly the new business leaders, the entrepreneurs and visionaries of today and tomorrow are saying, I don't want anything to do with public equity. I find this whole relationship thing of every 6 months having to go and see 40 institutions to give them answers to short-term questions, and where they frequently display a lack of detailed knowledge, which is not unsurprising given how many shares they're invested in, wholly unsatisfactory, and I want no part of it. And I think that's not good. It's not good for our economy, and it's not good for our society. So, Mr. President, I'm sure I've upset a lot of people. I do not hold back in expressing my views. I expect to be challenged, and I look forward to hearing views and doing my best to try to answer questions. Thank you very much.
Wow, that was a lecture and a half, right? I mean, Lord Miners started off with the asset managers and then went into the business leaders, and from there sort of looked at the trustees and eventually ended up with unicorns. And so I'm sure there's many questions from the floor. There's a lot of asset managers in the room that are thinking about things. There's actuaries who are thinking about, sure, he's wrong. I mean, we should be having a broad enough portfolio to diversify. So let's start with the questions. What I'll do in order to just facilitate and make sure we get sort of engagement across the piece is I'll take a question from the room and I'll take a question from Twitter, and let's see how we get on. So let's go. We have roving mics. Who will go first? Yes, we have. Please remember to identify yourself. Thank you.
Thank you very much. Stuart Stevenson, and I'm a member of the Scottish Parliament, and I've only put my hand up because nobody else did. But is the conclusion that we should reach from the proposition that we've just heard, most of which I find myself in significant agreement with, is the proposition that we should require investors to sit an exam to show they understand the business in which they're investing before they're allowed to invest? Or is that too extreme a conclusion from what I've been hearing?
Thank you very much. When I did my review in 2001, I was originally minded to set a test of competency before somebody could become a trustee of a fund. And we actually did some tests on investment understanding amongst trustees. And I remember that one of the questions we asked 400 or so trustees was, if long-term interest rates rise, does the price of a fixed income security increase or fall? We didn't take into account convexivity and other things. The problem with this question was that there's a 50-50 chance you get it right. So there was a supplementary question which said, are you confident that you got the answer right? 34% either got it wrong or were right but weren't confident. I'm in a room of actuaries, but goodness me, if you have not understood the relationship between interest rates and bond values, you really haven't gone very far in investment knowledge. So I wanted to have a competency test until Sir John Kingman, who's now chairman of Legal and General and doing a review on the Financial Reporting Council, but who was then a Treasury official, pointed out to me that if we introduce this test of competency, most members of the cabinet would not be able to serve in their present positions. And so I think as part of a self-evaluation process, if I was a trustee, sir, I would want to satisfy myself that my colleagues around the table were familiar with these issues and that they were spending time reading and keeping up to date on issues and were open to new suggestions. Thank you.
Thank you. Let's take the first question on Twitter. And actually, the first is actually from our immediate past president, Marjorie, who's sitting in Johannesburg, who I guess is asking the question, in emerging markets, what do you think about long-termism in investment in those sort of markets?
It's a challenging question. I think one of the things we need to do is to ask ourselves far deeper questions about indexation or the indices that we replicate. When I first went into fund management in the mid-1970s, I remember we had a standard line at Rothschild's that equities, and UK equities in particular, were the natural asset for a UK pension fund to hold because they balanced the nature of the asset and the nature of the liability and the currency. That's certainly not the case now because we have far more international companies. That sort of simplistic thinking. So I'm not even sure whether a FTSE 200 or 500 index is a good proxy for UK investment in any case. But when you come to emerging markets, I think you have additional problems around things like the quality of corporate reporting, and in particular, that in those markets there tend to be very substantial family or related or cross-corporate holdings. And so I think actually the case for active investment is even greater in emerging markets, because if you follow an index, you're almost certainly following something which is deeply flawed.
Thank you. To the room, another question.
Thank you. Hi, it's Kirsty Ross from Royal London here. Last week, a task force was announced to look at the rules with regard to investment in so-called patient capital, where investors are rewarded for investing for the long term. And I just wondered, how far do you think that will go to help the long-term view, both of fund managers and also, I guess, trust in the fund management industry as a whole?
I always sort of lead with my chin. I think the fund management industry has shown itself perfectly capable of looking after its own interests, particularly in terms of the fees that they've been able to charge and the generally prosperous lifestyles of people in that industry. So setting that to one side, it's not one of my objectives. I do think a more patient approach to investment is necessary. I was talking to a couple of members of the Institute before, and one of them was saying he's just been at a trustee meeting today, and I really think it's quite fascinating. Why do trustees meet with their investment managers, as many do, every 90 days when you're funding a liability which may not mature until 2050, 2060? I think the quarterly meeting is another little contributor, a little tiny one, to the short-term approach. You know, your heart used to sink when you'd had 3 bad quarters in a row and you were going to sit in front of people who were going to ask you why you were 0.2% behind the benchmark, to which the right answer, but was rarely given, is it really doesn't matter. It's noise. It's happen chance that that's happened over 3 months. It's no evidence of skill at all. So why are we even reporting on performance over 90 days? I would certainly have a 90-day check on compliance with guidelines that had been set, that if you've been told to invest in UK equities, you weren't investing in South African equities, with all due respect, President. But the idea of having 4 fund managers come in for an hour at a time in the morning to talk about the consequence of the American midterm elections for investment in Japanese small companies was, I'm afraid I spent a lot of my life doing that, and I look back on it and think, what was happening there? So, back to your, I think anything which accepts that patience is frequently a prerequisite of good performance, of riding out dips in with the prospect of getting a superior longer-term return, must be good. And I encourage government, regulators, trustees, and everybody, think long-term. Think longer term. Stop being obsessed with immediate gratification.
Thank you. I have a question from Staple Inn in London, from Martin White, who says, what do you think of the argument that active management is actually needed in order to ensure that you have price discovery?
I think that's right, and I'm not suggesting that you don't need active if that means value-based investment decision-making. What I'm arguing against is hyperactive, hyper short-term focus. Now, interestingly, the growth of passive investment. It does what it says on the label. The ETF or the index fund replicates the index and does nothing else, doesn't deviate at all. Over the last 10 years, the percentage of American company equities owned by passive funds has increased from 15% to 34%. In Europe, the figure has increased from 11% to 23%. Moody's forecast that the majority of the equity of American and European companies will be owned by passive funds, computers, by sometime between 2022 and 2027. So I think, Martin, you're right to ask where does price discovery come, because that is important to allocate capital. We should provide capital to companies which are showing a capacity to invest it more productively than others, and the index can't make those calls. But neither can managers who are really not far away from indexation, which is why I make my case for having more managers who are more focused in their investment. They exhibit more conviction about their selection, and they use voice and other forms of support to enhance the performance of their investment. So I think in that situation, we would continue to have good capital allocation pricing.
Next from the room.
The gentleman in the middle, where are we?
There is. Yep.
Hi, Dan Bryant, Standard Life. You spent a long time talking about trustees and their effect on fund management decisions. But increasingly, funds are being invested in by individuals with the rise of DC who are unlikely to accept the volatility of having, say, 20 equities. So how do we ensure a long-term view in the everyday man on the street?
Well, there is a risk of, particularly if you leave investment decisions in the hands of individuals, of reckless conservatism. That individuals will, because they're nervous about volatility, actually not stray very far from deposit funds and short-term debt funds. And we know, and I don't think anybody's challenging this, that more volatile asset classes like equities will be priced to produce superior long-term returns. So there's a risk there, I think, that if left to themselves, the individual will make not very sensible decisions. When I was chairman of the body which became NEST, the auto-enrollment investment body, we spent a lot of time using the insights of psychologists and sociologists on nudge to think about what investment options we should give. And we wanted to keep it relatively short with a focus on mixed funds. If I'd had more time, and most of you are probably glad I didn't, I would have ranted on also about the fact that funds have no voice of the investor. Very substantial investment funds are looked after by the investment management company or the insurance company, and there's no equivalent of a non-executive director. I'd quite like to see that happen as well. It's not your question, but it's just another of the bees in my bonnet.
Professor Mackenzie, you had a question? Thanks, Kaylee.
Listening to the discussion, I wondered if actually there really is a very deep problem here, which I would think of as a public goods problem in the technical sense of the word, because there's no doubt that active management is a public good. That is to say, there are wider benefits in terms of price discovery, as a previous questioner put it, also in terms of the governance issues that you've described. But if the efficient market hypothesis of financial economics is correct, and I think the evidence for it in this domain is not too bad, then the active managers that you're describing are not going to perform much better than passive managers, perhaps not on average perform any better than passive managers. So the private benefit will not be captured. And that's, of course, precisely what makes something a public goods problem. We know that the tendency of, let me call it a capitalist economy, is the undersupply of public goods. So perhaps we are dealing here with a problem of that deep and often intractable kind.
I think you've captured the issue very eloquently. The unchallengeable reality is that high-paid fund managers who sit in front of screens and visit companies and spend lots of time with research specialists, on average, over any reasonable time period, whether they're managing endowments, pension funds, or mutual funds, underperform a randomly selected portfolio. Certainly the index. I would imagine if you had a model which allowed you to throw enough darts at the back page of the Financial Times, you would also say a portfolio randomly selected by the throwing of darts. That's quite a big issue, particularly if you're paying high fees. So fund management falls short, in my view, as currently conducted. And I feel sorry for fund managers because I think they've just been given overly restrictive mandates and not been able to demonstrate their talent. But at the moment, they do not deliver value for money. And yet they extract billions, tens of billions of pounds out of their clients for fees and transaction costs. And in the course of their business success, which is largely based around accumulating more assets to manage. Remember, I told you Gartmore grew from 1 billion to 80 billion. They have also acquired very, very substantial economic and social power. They don't want it. They're discomforted by it. It's an unintended byproduct of commercial success. They would rather not have responsibilities for pay, remuneration, or anything like that. And yet fund managers can importantly influence the attitude of companies to the payment of tax, to how much they spend on R&D, whether they offshore or onshore, whether they insource or outsource. These pressures applied by these fund managers who don't really have a monkey's interest in the outcome and don't have much competency in responding to it, nevertheless have this huge power. And Professor, I would say, I'm overstepping my mark here, so please indulge me. Most people who have power have actually gone out intentionally to achieve power. They've gone into politics or into the upper echelons of universities to be vice-chancellors rather than sticking to their academic calling. Fund managers have got this power entirely coincidentally. They don't want it, they're uncomfortable with it, and they'd rather not have it. But they have the power to make or break. I'll give you a little example. When I was young, one of the great British companies was the glassmaker Pilkington. Pilkington was a world leader in float glass technology, and it was based in St Helens in Lancashire. It was acquired about 10 years ago by Nippon Glass. Since then, nearly all the technology and production has moved from St Helens, which is now increasingly a shell community, to Japan. Interestingly, the chairman of Pilkington at that time subsequently became chairman of Arm Holdings, which was Britain's leading publicly quoted technology company. It was taken over by a Japanese company 2 years ago, called SoftBank. Last year, SoftBank transferred all the intellectual propriety patents of Arm Holdings out of the UK into a company in China. And this is what happens because As far as the investors were concerned, it was a bid which came just after the Brexit referendum. It was at a 30 or 40% premium. And the Prime Minister and the Chancellor Exchequer said, we welcome this bid. It's evidence that Britain is open for business. No, it's evidence that we have the mentality that our major companies are part of a garage sale.
Okay, I have one more question from the online. This is Nick Spencer, and something that's becoming very close to the hearts of actuaries, which is all about sustainable investments, climate risks. Is that sort of thinking a step in the right direction if sort of insufficiently applied at the moment?
I think it should be at the heart of investment decision-making. If you invest in a company which is doing bad things, morally suspect things, then I think you need to be very cautious about valuation. We do have the issue of externalities, which is where a company pursues what is in its own best interest, but there are consequences for broader society. And I worry about that because we are consuming our world very rapidly and certainly not renewing the things that we're consuming. So I think any good investor should take into consideration ESG, and I think there is a case for giving ESG mandates, although I think that should, and I don't think it's a necessary consequence that ESG produces lower returns. In fact, I think I'd argue that ESG may produce better returns. But yes, I'm involved with a firm which manages ESG funds. I'm involved with another firm which is absolutely, and this is a fund which, to show you that you can do what I say, I'm a general partner in a fund of 13 billion euros, which only has 12 investments. That's high conviction. We have no underweightings, and we sit on the boards of 75% of the companies in which we're invested. We have ESG as a primary screen, so it can be done, and the two can link together.
Another question from the room.
My name is John Gill. Do you think regulators who are frequently blamed for short-term problems are likely to have an appetite for the increase in short-term volatility that a long-term focus would bring?
In preparing for this evening, I've read I've tried to read widely about this, and I found myself getting into neurological studies and the book by those two American academics who got a Nobel Prize 3 or 4 years ago on heuristics. Delved quite a lot into decision-making around the short term and the long term, and how people could respond very differently if a problem was posed in one way rather than another. But there was an inclination to over-discount the longer term and to take the cake and eat it now rather than put it away for a while. So I think there's I think the first stage of being able to become comfortable with a longer term approach must be to accept the rigor of some of the arguments that are advanced to suggest that we're overly short term. And as I said, I believe that short-term attitude is pervasive at every point in the investment chain. It's not just the problem of the fund managers. It's not just the problem of the companies. The reason why we have 3-year LTIPs for chief executives is because 3 years is better for the executives than 4 years or 5 years. Or at least that's the way they think it is. And so it requires we all have to become more comfortable with the sort of thing you're referring to.
Right, we're starting to get to the point to wrap up. So I've got two questions from Twitter. The one is from Paul Benemgi, who I think you've sort of answered the question, but he's saying, is the conclusion then that private equity is the solution? And I'll take a second question actually from somebody from the University of Exeter, Amy, who said, with so many graduates going straight into fund management, what is the responsibility of universities to instill long-term thinking?
Let's deal the second one first. Amy, good evening. As we say in Exeter, go green. Exeter has more trees per undergraduate than any university in the UK. My son, who's here this evening, is an undergraduate at Edinburgh. We have constant discussions as to which is the better university, Exeter, where I'm Chancellor, or here in Edinburgh. But as three of my children have been to Edinburgh, I guess the family vote is fairly clearly in favour of Edinburgh. Yes, I think universities do have a duty to address some of these issues, and I think it's not just in finance, but I would hope in the business school under Professor David Allen at Exeter that there is plenty of discussion about the longer term. You're right that many graduates are going into finance, community and investment banking and investment management. The good news is that graduate career choices are generally a pretty good forward indicator of an industry which is going to go into decline. And certainly if I was young now, I would not be going into financial services in the expectations that I would be anywhere as well rewarded as I have been over the last 30 years. And remind me, Jules, the first question was, is private equity therefore the solution? About 20 years ago, one of our fund managers at Gartmore said, I'd like to introduce you to a man who's coming into the office in a few days' time, but I want to give you some briefing notes in advance. And the visitor was Henry Kravis of KKR, the Wall Street private equity giant. And Brian O'Neill, a Scot, said to me, you will look at their performance numbers and be very impressed, Paul. But, in fact, if you had taken a portfolio of American equities and simply leveraged them, how much leverage would you have had to apply to the portfolio to get the same return? He said the outcome was 9%. Now, compared with the embedded leverage within a private equity fund in the companies within the fund, that's actually lower risk. But I think anybody who went to a board of trustees and said, look, don't invest in private equity, just leverage your equities, would be laughed out of town. But I do think that's the sort of discussion trustees should at least have to better understand the issues. Private equity is expensive. It lacks transparency. But it is benefiting from one of the effects I've described, which is the general wish of bright managers not to be in the public equity arena. The problem for private equity is it's an interim holding period because private equity has a flaw in its business model that it has to sell on. But firms like really good private equity firms like CVC and Carlyle are now launching funds with a much longer duration. They're talking about keeping their investments for 20 years or so. So I think private equity is a sensible place to invest. I have to say, hedge funds have been very disappointing over the last 10 years, and that's one asset class I'd be looking at with great caution. They may manage too much money. They may have become so pressurized by consultants and trustees to have formal processes that spark that was there with great fund managers, that intuition, that decisions made from the tummy rather than from the head, has been smothered out of what they do. But I'm a little bit cautious about hedge funds. And finally, infrastructure is a great asset for a pension fund and a long-term scheme. The problem there is that fund managers have not been willing to take as much risk, and they've expected government to take most of the risk, and so the returns have not been as high as they should be. And despite institutions saying we're ready to put lots of money into highways and airports, etc., you can bet your bottom dollar that very little money will go into HS2 or the third runway or any other major project from institutional investors, except in the very lowest risk tranche, which is guaranteed and by the government, etc. Thank you very much.
Thank you, Lord Miners. No more time for questions. Unfortunately, I think we've had a really good discussion to follow Lord Miners' lecture. I mean, that was an absolutely fascinating lecture. Thank you very much for making the time. I think a lot of what you touched on actually is close to the heart of the actuarial profession, about long-termism and understanding value and economic sustainability. So it was really apt and appropriate for you to be here this evening. Thank you very much.
Thank you.